How do we do that? We did it here on the intraday, right? And we already went over this example, right? But we had a move up, come respect that extreme high. We swept, manipulated, broke structure, so we manipulated to the high side. Lots of people will be buying from here, right? Thinking that this is like a 1 hour change of character or whatever. But obviously not, right? We're liquidating those people. Especially these ones down here, right? They thought this would go higher. It didn't go higher because we failed to displace over our point of decision. Why is it a point of decision? Because it's a decision point of displacement versus, which would be a market structure shift versus, having a trap, okay, where we continue to the downside. Right. If this did displace, this will link to here. We'd have a 1 hour range. We'd have to come all the way up to this 1 hour high because we need to follow the extreme range orders, but we didn't, right? And that's where it tricks a lot of people into thinking that we would. Reversal range stacking. So this is more so what happens in the market. How like if we're reacting to a high time frame area of interest, how we actually reverse from that area. Okay. So range stacking is when we enter a POI and mitigate out low time frame ranges to continually move higher or lower. In this case, higher and higher. Okay. Use this as a tool to understand how we mitigate out our ranges. Our range winner means we can now be in a higher time frame working range. Right. So quality didn't turn out great, but starting from this extreme, we have a 5-minute sweep and break. What does that mean? We connect to an opposing 5-minute sweep and break. We have a 5-minute range. We mitigate out the supply, create inducement for demand. We break, right? Now what do we have? We have a sweep and break of a 15-minute range, right? I'm making these time frames up, but this is what happens, right? We have a high time frame strong low now, so that links to a high time frame strong higher to the left. Yeah, we have our premium and discounts as well. So now we're in this low to this high's working range because we created a 15-minute strong low by breaking the M5 strong high range high, displacing. We react to it, induce, continue to the upside, and then what do we do again? We broke the M15 strong high and we created an M15 sweep, which means we've got a 4-hour strong low, right? So disregard this H1 because we're not connecting a 1 hour strong low to this, but we got a 4-hour strong low, right? So now we have to trade to this extreme range because we've connected this 4-hour low to this 4-hour high. We induce into the demand. This buy is a beautiful buy because we know we have to come reach these extreme range orders following our range rules. And there you go. That's kind of how we work, ourselves out of low time frame ranges to high time frame ranges. But that's also working outside in. Sorry, inside out. That's how we work inside out. Current price, what's it going to react to in the future, what's that going to react to in the future, etc. Right? This says at this displacement, our extreme range low now links to the extreme range H4 high, right? Because we broke that M15. It's not. It might be H1, might be daily, right? I just made up these time frames, but this is what happens. So check that out. Cool. All right, liquidating the masses onto our next. So we've gone through time a little bit, gone through a bit of structure, ranges. Now we're looking at liquidation of the masses. And like mentioned before, how can we use retail strategies to our advantage? Okay, just give me one sec. Alright, we've all been there, right? So the first thing you type up when you search learn to trade, which we've all been in that, place in the past, is the abundance of retail concepts we all know and hate. You might not hate it. Look, you can be profitable off retail strategies if you have your risk management right. Please don't do that, but you can, right? So I should have put hate there, but it's alright. We've all been there. The deeper down the rabbit hole, you may find smart money concepts and ICT, right? That's where everything tends to cut off. It's up to us to study how the market works, because the rest of the real knowledge is hidden. It's purposely hidden because the banks don't want us to know, and everyone behind us has given up, right? So you guys are very, very lucky that you're here, just because we're deep, very deep in that rabbit hole, okay? And we got a reverse engineered outside view of really how that market works and what's objectively consistent, and that's exactly what you want. Rather than throwing away the idea that these traders are useless, I sound harsh here, sorry. We can use them to our advantage to detect our inducements, right? We want to see retail traps line up as our inducements. Like when we look at a phase 2, we have a nice horizontal level, but what's the retail trap that's going on in that, okay? So the idea is that we liquidate all these traders before we take our real manipulation-based entry. Use retail traps to locate inducements plus the respective mitigation cycle into institutionally funded strong high, strong low order flow. That's the main idea we're looking at. All right. So let's jump into the charts. Detect some beautiful retail traps that we liquidate, because I'm sure we'll liquidate most, maybe not all of them, but most of them. And let's use Asia as a framework. What are we looking at? We're looking at equal highs, equal lows, also known as support and resistance. We're looking at wedge build-ups or breakout traps. Oh, we broke out. Let's buy. No, right? Reverse on you. We manipulate them. Use the bottom as targeted liquidity. Smart money traps, right? You got to know what's going on with your zones. Don't get caught in a smart money trap. If you're still learning and you have a lot of zones, that's completely fine. My tips for that is don't over refine, make a zone too big, because what we're doing is we're waiting for reaction within that zone anyway. So if your zone's too big, it's completely fine, but also wait for your phase 2. Now, not every entry needs a phase 2, but I recommend you use your phase 2 if you're still learning, okay? It's very, very, very effective. It's our trademark, right? And then a head and shoulders, whatever, it's just a chart example I've heard of a few times, okay? But we can also see that as a kind of a wedge pattern or whatever. So let's jump into the charts. We're on the 15 here. And let's start from here, right? So straight away, we're just identifying the traps. Let me turn off this magnet tool, okay? Right, trend line, right? Before what? POI. Beautiful. What does this do? Misses, right? So what is that? Smart money trap, right? Equal lows before the true IFC. Smart money trap gets reactions. This is where we'd place our entry, right? So we detected that as a trend line trap, and then we'd find our mitigation cycle here. This kind of acts as a second miss in a way if you want to look at it like that, but make sure you have your correct IFC level here in your order block. Smart money trap, bang. What are we doing on the upside, right? Beautiful channel, right? We can look at it as a channel like that, yeah? Creating that, liquidity that we can target for that move. Beautiful. This takes out all that liquidity, right? Comes into this sweep and break, not very nice, but we'll mark it out, right? Top side adds to an inducement up here. Manipulation, we could trade from that as well, okay? Beautiful. Next day occurs. This is what you should be doing every single day Asia starts. What are we seeing in Asia? Relative equal lows, bit of a build-up trap. You can see that as a channel to the upside, right? What is it linked with? Mitigation cycle 2 up here, right? What do we got here? We got a POI we could trade from. What did we liquidate? We liquidated all these people. We created a smart money trap down here. So we liquidated smart money traders. These people selling also liquidated, so beautiful entry here. And remember, the idea is that we want to place our trade after everyone is liquidated. Cool. Here, nothing really going on, but here, right, beautiful, right? Look at all those retail traders. It's easy to see, these people, they might have made some money. Good for them, right? If they're taking it out at the right time. But look at all these stop losses here. It's juicy. This low, right? Disconnected from what? Extreme range orders coming from this strong inducement low here. Obviously, we have some down here that we can mark for the future as well, okay? But we come into that, sweep that inducement, and then we move up very nicely. We have no more traps to take out, so that would be our buy position, right? New York opens, we open with an impulsive manipulation. So we can check our time cycles with that as well. But yeah, beautiful. If I want to look at this with my time cycles, right, we start at 3, go to 4:30. What do we have? X, L, because it's creating smart money traps, adding to this inducement. And right in M opens, we have the manipulation. Just beautiful how it all lines up, really. So it's the secret of the algo. Alright, so here, what do we have? Right, trend line down. Even on the bottom side, we have a channel, right? Who's buying from these? All those taps are getting bought from retail traders. What do? Trap, mitigation cycle, bang, take them out. Smart money trap down here. Beautiful, take them out. That's our trade. Up here, right, we just have a continuation of that original manipulation, and we come down into these targets to take out what? This. Why is this important, significant? Because this is full of liquidity, right? Because that got protected for a little while, all right? It's previous day liquidity. So we take that out with what? Vector candles with absolute force. What do? We break that vector level, have that market structure shift. We have a very nice point of interest, institutional, that we came from. This mitigated here, so we have some support that we took out. What do we have again in here? We have this small channel leading into that POI. Bang, bang, bang. Beautiful entry here as well. Okay, let's go over some more. Damn, it's just a clone of what happened this day, right? Another clone. We had a beautiful channel down to the downside. This took here. I think we looked at something like this before, but bang, beautiful. Took them out. We have our buys here. All right, let's go to the next day. This took out a bunch of inducement and reversed because inducement is fuel. We had a movement to the upside here. We had a disconnect of price, and this actually swept liquidity and broke structure. So we can see that this is actually going to hold because of that, right? So we don't want to use this low as liquidity, but we created that internal. Beautiful. This can act as our phase 1. We can look in here for our phase 2. Simple as that. Smart money trap to the upside. It's a supply with no inducement. We target that. We have that bullish momentum. Beautiful, huge trade to the upside there as well. And we're not even using our ranges as well. And our range rules really help us find that and our time. Big build up, right, to the upside. Just like that, we respect, we move up, sweep liquidity, probably enter a higher time frame zone to the left here. We break structure, we sweep into that structure, we have continuations, and we take out this build up liquidity that got created in Asia. This day is kind of just a continuation, reacting from weak orders, so I'm not going to analyze that. We'll do a few more. Asia, right, does create a sweep and break, but we, on the high time frame picture, we have this big channel build up, right? Trend lines or whatever. This low comes deep to fill that imbalance, right? This low will act as inducement for that. We break, have continuations to the upside. Okay. Last one, relative equal lows get formed here. Under what? Our inducement based structure. Move to the upside, take out this liquidity. Cycle repeats itself. Okay. One more. Build up to the upside. Build up. What do we rapidly do? Take that out, manipulate, follow those orders to the downside to the next targets. Okay. Sweep liquidity, break structure, take out. Do we take out? No, we respect that, but we sweep, break, continuation to the upside. Simple as that. Oh, I've got to lose my voice. Oh my god. Okay. So that's kind of a just straight up live view, just some random charts, how we can use Asia as a framework to identify these and link them with our mitigation cycles into what? Our institutionally funded order flow. Simple as that. Make sure you're using your ranges and your time as well. And then we got the complete algo diet working out for us beautifully. Alright. So this was sent to you guys, but just an example of what can happen here. If you can see, we have our range. Apply the range rules. Make sure you apply your range rules. Right, internal strong highs and strong lows can be traded to the extreme range orders. So that's exactly what we're doing here. We have a build up in Asia. Frankfurt opens. We hit a point of demand. We run up. Okay, we sweep into our institutionally funded candle, which will be from this order block, right? We always got to find an IFC level within your order block. Sweep into that, break structure, right? So this acts as a support to resistance, however that you want to look at that, right? But we liquidate those people, take them out, come into this supply, move lower, sweep this inducement, come into this demand, move higher, right? Because we're just taking everyone out and running, taking everyone out and running. So algo diet, the one setup, right? This is these are the one setups you need to see before you enter. Whether it's a phase 1, phase 2, doesn't matter. But this is really it. You have a strong low, you have an inducement, you have targeted liquidity, you mitigate, you run. Same thing here. You have a strong high, you have an inducement, targeted liquidity, mitigate, run. Simple as that. That's what every entry setup will pretty much look like in its own weird way. But make sure you got this, okay? Make sure you got it. And I suggest print this out with your system as well. The algo diet, you'll find it in extra resources, but we have to be identifying our strong highs and lows with their displacements. We have to be identifying time and price, which is exactly what we went over today. Time and price, how they're linked, how we can use time to our advantage. The algo does it. That runs a market. The market maker algo does it. So we got to do it. We got to clone what they're doing, right? Liquidity, inducement, right? So liquidity that acts as inducement for our order blocks. Beautiful. Form for our strong highs, strong lows. Discount, premium and discount. The algorithm follows premium and discount based on having valid reaction points from strong highs to strong lows. So we got to follow that as well. If you're trading, say we're looking for buys in your premium, you're going to get liquidated. It's going to be a smart money trap. So why take the L, on that? What is a algo can't eat? Well, it doesn't like trap pricing. We just went over that. Retail traps, right? It will not fuck with that. It will not mitigate that out for you. And weak highs and weak lows, right? Kind of same as a smart money trap in a way, but we need strong highs and strong lows to be mitigating. And we need those external inducements to line up as our extreme range orders. Okay. System refinements. So you guys should be making a system. I know maybe some of you are newer. This is a little complex or whatever, but you come back to this. Yeah, you need to build that system. You need to follow a set of instructions in the same way that the algorithm does. So we've went over order blocks outside of the webinars, but we haven't in a webinar. So we'll just quickly skim over an order block in the webinar. I'm going to quickly draw up a thing, and then we're going to look at this. Okay. So if you have a point of interest, okay, just like this, right, it'll always be active if we have a point which is a high or low that hasn't been mitigated into, right? So I'm just going to move this for the sake of it, okay? But see how this took out this liquidity here? What does that mean? Well, think of it in the perspective of the market makers themselves. They put a bunch of sell orders at this point here, right? They don't have a stop loss. They don't even use a stop loss, right? So they have a bunch of sell orders to take out this liquidity. Now, we've never come in to meet that level, which means they're in drawdown. What does drawdown mean? It means they're minus a lot of money at this point because they created a false move to take out inducement, right? So we need to come in to reach this institutional level, and then we can use that as a point of interest. So it's a way the algorithm sets horizontal targets to enter into to get rid of that drawdown. That's what it's really interested in. If we don't have an IFC level, right? If we don't have an IFC level for our order block, it's not going to work, right? Because there's no reason for the algorithm to go to that area. Alright, so I hope you understand that. If you don't, I have a few examples on the Discord. But that's how your order blocks work. And it can even be really, really tricky, right? It can be like this on the 1 minute, like that, right? And then obviously this is going to act as an IFC because it took out this liquidity, right? But so is this. It's going to act as an IFC here because why? It took out this liquidity here. So we can end up doing something like this, running, and then coming back to this later down here because we haven't fulfilled these sell orders here yet, and use that first mitigation as the inducement for it, right? Cool, I hope you get that. Let's just go over these points. So these are different order blocks we can encounter. It's not different order blocks we have because they follow all the same concepts. We have the basic one where we have the buys here, taking out this liquidity, simply our IFC. We can find internal refinements from the extreme range mitigations in there if we want. But like I said, don't over refine. It's not worth it, especially if you're playing a phase 2. Why would you over refine when you're looking for a 1 minute order block anyway? It like doesn't make sense, right? You just miss a trade and get annoyed. But make sure your zone is the active minimum to maximum. It's not like missing that. Okay. Hidden order block, right? We have our IFC level. We maybe have one in there which I should have included, like a smaller one that took out this. But this failed to mitigate into that smaller one, so we take that out and use it as inducement to go further down. Alright, so we need to really see that sweep into there. That sweep is an institutional order flow. What's it doing constantly? It's grabbing inducement, mitigating, grabbing inducement, mitigating. So follow that. Why do I cut off my zone here? Because it's a money transfer. That's why you're going to cut off your zones as well. Double order block. Like I talked about just in the example I drew up before, we have an IFC level here, and here independent liquidity, which means liquidity is being taken out for this and this one. So there's two IFCs available. We mitigate this one and then uses that high as inducement to mitigate the one above. We can do that as well. Trap order block, right? So if it's shared liquidity, not independent, if it's shared liquidity, it means that if we mitigate into the IFC, right, we're still going to run, even though it didn't mitigate into the extreme IFC, right? So just be cautious of that. And then we'll read this. Keep in mind, orders can internally transfer from the extreme. We must use an IFC level within our order block. Make sure you use one. Ensure you understand how they work. Banks and financial institutions create a false move in the opposite direction to sweep liquidity. This then breaks, creates a strong high and strong low, and their entries in drawdown. They must reach this level. Order blocks are levels, right? They're levels they have to reach. Yeah, and a good trick is just grab the consecutive candles that swept the liquidity if you're a bit unsure. Find the low that swept it, then grab all those candles and use that as your order block, right? I recommend you start with that, and then over some time you get more advanced, you understand how to find them a bit better. But yeah, like I said, it could be a single candle, could be 2 candles, could be 3, but find the candles that actually swept that liquidity, because that's the level that price is really trying to look for. Okay. Just summary: what took out the liquidity? False moves in the opposite direction or in drawdown, right? Order blocks are formed from impulsive rush of BFI orders, right? Like they take out this inducement and then bang, it runs, creates imbalance. Going back to the basics, right? Creates imbalance, break of structure, impulsiveness, inducement, mitigation. Simple as that. Liquidity sweep into a key level versus non-key level, right? So if we're sweeping this liquidity into an active IFC order block, then of course we're going to get a good reaction. But what if it's already mitigated, right? We can use it as a pullback and a continuation to the upside. We go over that in some of the last webinars. The obvious order block will never work because, the market makers, in my opinion, they have a liquidity detector. They know exactly how many stop losses are placed at which point, so the obvious order blocks where everyone's going to put their orders, right? So that's probably going to get taken out and then it's going to run. So be mindful of something like that to happen, all right? M1 for entry and refinements only. Seconds for M1 mitigations only. Don't be using M1 for anything but your phase 2 entries and your refinements within 5-minute order blocks. Please. Okay. You can start using it for other things in the future, but please just follow this rule here for 1 minute. You don't need seconds. I like using second because I have the understanding that to be able to do so, but you don't need it. Trust me, seconds will haunt you because it's just so volatile. Okay. System refinements, just to sum up our system refinements, your goal should be that your system only fails because of human error. Now that's a very, very tough goal to reach. Of course it is very tough to reach. But you have the tools, you have the equipment, and that's the larger goal that you should be chasing. If you do not have a risk and technical system, you cannot trade like the market maker algorithm. If you haven't backtested following your system like a set of instructions, you don't know whether it will work or not. You have to do that to test it. Add time and what you learned today into your system. Just get a quick drink, sorry. Yeah, please, if you have a system, and that would be fantastic if you did, add the time stuff you learned today in it. XLMC, LMCX, learn the functions, learn how to graph it up, and wow, it'll help you so much. If you guys are sending live trade ideas tonight or the week coming, whatever, I want to see that implemented, alright? And just to finalize some trading tips, okay, we can use manual inducements, right, with a mitigation cycle, meaning you can mark areas of high liquidity as potential inducement points for a reaction, such as an inducement pullback or reversal. So you can grab daily highs and daily lows out, because think about it, if you have a daily low, previous daily low, all the people from that day bought from that low. So if they have their stop losses still in the market, they're resting at that low. So if you clean up that low, it takes out all the people who are still in buys from yesterday. So just think about it like that. Same thing with the high. Same thing with your weekly highs and monthly highs or lows. Obviously, not a lot of people. When I say not a lot, I mean like billions. But not a lot of people are going to have that amount of money at those monthly highs and lows, if they haven't taken it out, whatever. Session highs and lows you can use as well because that's holding all the sessions liquidity, like a London low, for example, is holding all the London buys. And range highs and lows as well. So when you exit a range, that's why you should always use the range high and low winner as a partial or a full target, always. Okay, so add that to your system in targeting. And again, if you need help with your system, let me know. And I'll be sending in my system now. And the reason I've been holding off from just sharing the back testing and the systems is because it has the time stuff in it. And I didn't want to give you the time stuff before teaching you guys. Okay. Stop loss placement goes where price should not return. So breaking it would mean the flow or idea is not valid. All right. So add that to your system. Make sure that if you have a trailing stop loss, if you move it there and if it breaks, don't second guess yourself, right? If it goes against your system and your idea, it's no longer valid. It is what it is. Don't get a mitigation confused with inducement. I'm guilty for doing this, rarely, but sometimes it happens. That's a human error, right? And it'll usually happen when you have like different chart spreads. You got to check what one you're using specifically, in my opinion. So you got MetaTrader open, check that before you take the entry. Don't just use TradingView because you could get confused with a mitigation as an inducement because it could look different. Trade away from your inducements, right? If you have a sweep of this retail liquidity, right, you want to trade from that sweep. We're trading away from the low of that sweep if it's taking the sell side. Use the 3 Asia types with what we went through today as well. Make sure you know your Asia types. And that is a wrap of everything, guys. So if you want to ask a recorded public question, you can now. I'll give you 10 seconds for that. Okay, I'll stop the recording.